Hey everyone, happy Thursday, March 2nd. It's about 11:45 on the West Coast, and it's time for another market update. The good news I can tell you is February is over. February is awful for mortgage rates, starting with that BLS jobs report, but it's over with now. The bad news is that March has started off on the same kind of note. Going back to last Friday, we got that big January PCE inflation number, which is the Fed's favorite form of inflation. And the core rate, which they really look at, came in plus 0.6% month over month, plus 4.7% year over year, up from the previous report at 4.6%. And it was actually expected to drop to 4.3%. So like we've talked about before, inflation is the main enemy of mortgage rates. These inflation numbers, the Fed is really paying close attention to. So that's been bad for rates. And it was bad for the markets in the sense that for last Friday, things have continued to escalate. Next thing we got was Case-Shiller and the FHFA appreciation data for December. Keep in mind, Case-Shiller includes cash deals and jumbo loans, bigger loans. FHFA does not. So you're going to see a little bit of difference in those numbers because, right now people making cash offers are probably getting bigger discounts. So that's going to affect the appreciation numbers and the numbers on that kind of stuff. So the seasonally adjusted numbers are throwing out, since it's in December, they adjust the numbers a little bit to keep up with the weakness this time of year anyway. So year over year right now, we're showing from December, Case-Shiller National plus 5.8% still, down a little bit month over month. The 20 city, which looks at the 20 big metros, down or up more, up less year over year, 4.6%, and down more month over month. And the FHA is looking better than the other two, but like I said, that has to do with those cash deals. Only down 0.1% seasonally adjusted month over month, and up 6.6% year over year. And then, from the peak since June of 2022, the national is only down 2.7% seasonally adjusted. The 20 city, the bigger areas, down 4.8%, and the FHFA down 1%. So, down, not good to see. You don't want to see how prices drop, but far cry from a house pricing crash like some people are talking about. But we'll probably see some more weakness as we get further into this year. And then looking at a different index for that, the Zillow Home Value Index, we see a lot of the biggest decreases since that peak in June have come on the West Coast where we're all at. But keep in mind, we also saw the biggest increases. These areas didn't gain nearly the value we did. So if you gain 40% over the last 3 years and you're down 10% over the last 6 months, you're still up quite a bit. So it's the people that bought at the peak back in June, May, July or so. Those are the ones that we have to be a little bit more careful and keep an eye on. Next thing we got was January new home sales. So new construction was up 7.2% in January. Pending home sales were up 8.1%. The only thing I'll say about this is it's not going to be this good next month. January, the builders are doing a good job of offloading inventory, offering really good builder credits. That's a great opportunity for folks right now. And then pending home sales, January, these are people shopping in December, getting rates in December. Rates were better than they were all through this, how things have gone, this last month. So when we get the February data and the March data, it's not going to look as good. Purchase apps, like I predicted, were down 5.6% last week, and they're down 44% year over year with rates continuing to go up. Keep in mind, down 44% year over year. Last year at this time, the average conventional rate was at 4.08%. So that's a pretty good reason why they've gone down so much. The Mortgage Purchase Application Index, which the Mortgage Bankers Association uses to keep track of activity in our end of things, lowest point since 1995. So these higher rates have definitely affected activity quite a bit. But we've also seen when rates come down, activity goes up. So that's something, a positive thing, something to be optimistic about, is when they do come down, we should see the pickup in activity. And then this gives you an idea. If we go back to December 2022, the average 6.36 rate, the average person in America could afford about $346,000 house. 7% rate, they can only, where we're at now, can only afford about $324,000. And then if it goes down to 5.7%, which would be nice, which is what Freddie Mac had predicted, $372,000. So you can see how much the rates have an effect on the buying power of the average American and why things have slowed down so much. Next thing, initial job claims. So this is important, like we talked about, until jobs break, until we see some weakening here, the Fed seems like they're going to stay resolute with what they're doing, with their actions. So they were expected to have 195,000 new claims, only came in at 190,000. So another data point to back up the Fed's narrative, not good for mortgage rates, something we got to keep an eye on going forward. So where did that leave us this week with rates? The average rate went up from 6.82 to 7.10%. Very discouraging. 4 weeks ago, a little bit over 4 weeks ago, we got down to just under 6. And in just that quick amount of time, starting with that jobs report, we've gave it all back almost. That the highest we were at was 7.37 in November. So we need to see the data turn for this to change. Our first opportunity for that coming up is next Wednesday. We got the ADP jobs report, which looks at private payrolls. On the 10th, next Friday, after I do my next report, we'll talk about this. We get the BLS jobs report. So the same one that screwed us up last month, we're going to get the new one. And we're expecting this to be weaker and to hopefully start the downward trend and get some of our gains back that we've, some of this ground we've lost. Then we got inflation, the CPI coming up on March 14th, and then the Fed meeting on March 22nd. So if we get some good jobs data, if we get some good inflation data, the Fed meeting is going to go a lot different than if these things do not go our way. So, where does that leave us? It's obviously we got to get through where we're at right now. Tough market. It's tough for all of us. It's tough for borrowers, lenders, realtors, everybody. But like I said, there's some unique opportunities for people that can afford where rates are right now. One way to look at it, let's say that, by buying now and taking a higher rate, you're going to pay $100 more a month. Let's say, but next year, in a year's time, when we expect rates lower, you would have an opportunity to refi. So that's costing you $1,200 more over the next year, until you refi. But let's say by waiting for rates to come down 3 or 4 months or whatever it may be, you end up paying $50,000 more for the house, and you don't get any seller credits to help with closing costs. So you can see, paying $1,200 more for a year spread out, or paying $50,000 more for the house. Like, if you can afford it, you should do the first. So, like I said, every market's going to have some opportunities for people. Definitely not good for people on the margins right now, but for people who can afford it, some great opportunities out there. Waiting for rates to come down might be a completely different market. So that's all I got for you guys. If you guys need anything at all, please don't hesitate to reach out. Besides that, I hope everybody has a great week, and let's hope for some good jobs data when I talk to you guys by next Thursday. Have a great day.